We're here today at Corestate Corporate Headquarters in Tower 185 to talk to two experts about private debt and real estate financing. My name is Markus Schuld, and joining me here are Mark Holz, Group Head of Research at Corestate, and George Schattney, Group Head of ESG at Corestate. The two of them have recently published a comprehensive study on the topic private real estate financing with a focus on ESG compliant or green real estate financing. But before we dive into the results of the study, Mark, why do you, as head of research, deal with the topic of financing, and what is special about this asset class?
Thank you, Marcus. Hi, Georg. I'm happy to be able to talk about private real estate debt in this format, because it's still sort of a niche when you're looking at asset classes in Europe, but it is changing rapidly. There's tremendous growth in private real estate debt in Europe. And Corestate is one of the pioneers and leaders, market leaders in this field with HFS and Corestate Bank. So we are very interested, of course, in private real estate debt. And what makes private real estate debt interesting? What makes it attractive? What's special about it? In the end, private debt gives investors access to real estate without sitting in the driver's seat. So you're giving a loan to a direct investor or a property developer who is in charge of managing the property. In return, you get a fixed interest, you get a fee for your loan. So that means typically that you have a stable stream of income, and that is totally independent from the performance of the individual property. It's independent from rental growth, from capital value growth, from occupancy rates, and all that. So it is a stable stream of income, given, of course, that the interest can be paid by the creditor.
Yeah, how does this look in the wider ESG context? Is real estate finance still a niche here, or how would you classify the asset class in the wider ESG context?
Well, first of all, thank you, Markus. Thank you, Mark, for bringing up this topic. Well, let's first have a look at how we classify, or how real estate is classified in the context of the wider investment world. And real estate is part of the so-called hard or real assets, alternative assets. And these assets are, unlike, let's say, bonds or equity, they're not fungible. That's one of their properties. And now we come to the interesting part. They're real assets. So what is this? This is real estate. It's also real energy, so to say, renewable energy. It is real food because it's investments in agro, in forests. And if we look at this and we look how investors view that, they think it's an important asset class. So they normally, a normal big portfolio of your pension fund would probably allocate at least 10% to real estate, a bit more, a bit less, and some additional other alternative investments. Now, so say from investors' point of view, this is interesting, but it cannot be much more than this. Why? Because of regulation. From the ESG point of view, from the regulator's point of view, from the society point of view, this is the central asset class where we decide about our sustainable future. It is the new wind power farms. It is a more sustainable way to deal with our food production, and it is a more sustainable way to live. So this is a core asset class, and that's why it's being more and more regulated on all levels, and also, of course, on the finance level. And if you look at that from a very high level, flying at this jet altitude, and you look down on Earth, you see we are not the first sector that faces such a transition or disruption. 20 years ago, we remember RWE or E.ON here in Germany or others, they were all about nuclear and coal. And this is coming to an end. It's been a 20 years transition, but it is coming to an end, at least here in Germany, and I think all over the world, step by step. Now, 10 years ago, we were discussing, is it the combustion engine or is it e-mobility? This has been decided, and the same happens to us. And that's why there is a lot of investment opportunity. That's what we see. We think for regulated players with green products, but also for private players. And last but not least, just to close the circle, of course, you also need to deal with the risk part of that and have a look at climate risks and ESG risks in your portfolio.
Regarding the risk, Mark, at the end of your statement, you mentioned in a small side sentence that real estate financing is stable as long as it is serviced. Where are the major risks here?
Yeah, sure, you're right. Real estate finance is not a risk-free asset class. However, I think for investors, it's quite attractive because you can manage your risk quite efficiently, and it very much depends on the return profile that you're seeking. The higher your preferred return profile, the higher your risk profile in the end.
Okay, we are here already in the middle of the study, but Mark, before you go into the depth here, can you briefly say a few sentences about the study as a whole?
Sure. It's basically all about private debt for real estate investments. It covers the field in, I would say, three major columns, three major topics. That's general market trends for real estate finance, for private debt, particularly the growth in the field over the last years that we've seen. Then it goes in depth analyzing Germany's and Europe's real estate sectors, because that is key to understand when you're financing real estate. And the third big part is, and this is where Georg comes in as the co-author of the study, where's ESG in this finance spectrum live?
But you mentioned private debt is rapidly developing, and there's a massive growth in this particular asset class. Why is that part of the asset world so strong?
Well, in Europe, this goes basically back to 2008, 2009, following Lehman and the financial crisis. Banks have been very risk averse in giving out finance to real estate investments, to real estate developments. Also, regulation has been, it was much stricter following this from the regulator side. So there was basically a financing gap. And into this financing gap is where the private debt market has gone. So there was a gap, and that was filled by private operators. And pretty much the same thing happened when COVID hit. Banks turned risk averse again. Financing in certain sectors and segments have been very difficult to get at all from banks. And this again has spurred amplified growth for private lenders, for alternative lenders. And this is something that we have analyzed internally in depth. We have had a look at all the equity investment opportunities that we have sourced with our investment teams, and we have had a look at all the financing opportunities that we have sourced over the last 2 or 3 years. And there was a big distinguish. It was so that the development of those have been very diverse. While there was sort of a bottleneck for equity investments, there were hardly any, or not hardly, but there was a clear decline in investable product for the equity realm. On the other hand, you have the finance side, and that was pretty stable. Finance requirements from the markets have been stable or even gone up. And that allowed us to allocate money from our clients, to actually put money of our clients to work and generate revenues for our clients in the real estate finance spectrum of the real estate universe.
Meaning that the financial market in this aspect was more liquid than other parts of the market, and they're generating revenues on this side. But what returns can you expect in the area of real estate financing?
That's a huge range to start with. And it very much depends on the risk profile that you're willing to take. In the very low risk end, we're talking senior loans here, which typically cover a loan to value, so an LTV of 50 to 60% or so. The interest that you get starts at 0.8 to 1.5% in this range, going up dependent on location and asset specific criteria. If you're in the mezzanine space, shorter term loans, your interest can go up to 15% or more. And there's then other structures like whole loans, which is a mixture of senior loan and junior loan. You're typically in the range of 4 to 7% returns or interest for these loans. Again, dependent on the individual setup, the tenant, the covenant, and so on. So what's interesting about real estate finance, about debt and loans, is that an investor can pretty much tailor make the risk and return profile that really fits to the individual investor. And that makes the asset class pretty attractive for many investors in Germany and Europe.
So the study is dealing with a lot of aspects of the market. It is also much more sophisticated, as it indicates what makes the market attractive regarding ESG. Georg, you're the co-author of the study and an ESG expert at Corestate. Green real estate financing was also considered in the study. What is the status and what are the advantages of green financing today?
Well, the status is pretty clear, Marcus. It's going to be the new normal. Yeah. That's because that's what our societies want, and that's also what we need. Yeah, we need a greener sector, financing sector. So demand is rising, and we think demand will be rising, especially from institutionalized players, because they get a lot of pressure from supervisors to do so. Why? Why do they get this pressure? Well, the underlying logic is, and I think it's a correct logic, that non-green assets, so assets that pollute too much, that they have a higher risk. Yeah, but that's the underlying, so say, economic logic. But it should be said that at this moment in time, the main driver for all this is regulation. And what we have is a whole alphabet soup of new regulation, which is being cooked up in Brussels. And it's called SFDR, it's called EU taxonomy, it's called update of the Energy Performance Building Directive, etc., etc., etc. And all of that hits our tables, our business plans as a sector, but also here at Corestate. And dealing with that in an intelligent way, finding the concrete benefits for our investors. That's, so to say, the secret sauce. That's what we are working on and want to compete. And it should be said, of course, that it's not only Brussels, but in the case of Germany, it's also, of course, a really high priority of our new government in Berlin. Now, if we look a bit into the future, we think this development is really it's permanent. It won't go into reverse. Yeah, if it hasn't gone into reverse now during COVID, it will not. It's there. It's, as I say, the ghost is out of the bottle, or we say the I don't know how you say that. The toothpaste is out of the whatever. I don't know how you say that in English, but we really cannot go back to before. The interesting question is, of course, the financial part of that. What is my financial benefit for investing green? And there's this massive discussion going on since more than 20 years. So in theory, yes, you should have a greenium. You should have better conditions. In practice, that is being offered for green products, green bonds, sustainability-linked bonds. But we would like to widen the perspective a bit because it's not only, let's say, these basis points which you can get. It's also a long-term risk mitigation strategy, of course. Yeah, because in the end, who will rent an office which is not energy efficient in 10 years, but you might want to sell your asset in 10 years. And of course, there's quite some money on the table. We are talking about 750 billion in terms of the Green New Deal. We are talking about massive subsidies also on German level. So we try to piece together that complex picture, but the direction is clear. It's getting green, whether you like it or not. We happen to like it.
Mark, in the study, you also examined the general development of the different real estate sectors. What were your key findings here?
Well, the key finding is that the market or the markets are still very much dominated by COVID, indirectly or directly. You still feel the impact of COVID in the hotel segment, of course. You still see it in the restaurants and spa spaces. You still see and feel it in the retail world. But generally, the world is not black and white here, and you have to deal with the details. You have to really dive in and understand what's going on. Looking at retail, for example, your typical high street retail unit that suffered during COVID because they had to shut down for many months, depending on the country where you are or even the city where you are, while most of the supermarkets, food-based retail, drugstores, etc., they remained open and were pretty much unaffected by COVID entirely. And this has actually spurred a lot of interest from investors into the fast-moving consumer goods retail, which is food retail, drugstores, etc. So there was a lot of interest here, and actually that meant that prices went up in this field, while overall the retail market prices, well, declined, fell to some extent, dependent on the location and everything, of course. And it's similarly interesting, or even more interesting, when you're looking in the office realm. Similar to ESG, not for 20 years, but for the office now, for the last 2 years, there was an in-depth discussion: do we need offices at all? And many of the views were actually very black and white. Some say, doomsayers saying, no, we don't need an office at all. We will all work from home. And the others, often brokers, say, of course, we all go back to the office. There's no impact at all. If anything, we will need more space. And the reality is somewhere in between. You will have more home office, of course. People will be less in the office, but the direct impact on the space requirement very much depends on the location where you are, very much depends on the individual business. And I think there's separation of the market happening right now, where the strongest assets in the best locations with the best tenants, modern and flexible layouts, they will continue to perform very well, while weaker assets in poorer locations with no public transports, coming back to the ESG aspect of this, they will suffer. They will see less demand from tenants, falling rents, and falling demand from investors. And as I'm talking, you see how complex this all is. And I think coming back to the finance aspect of everything, you really need, as giving out loans, real estate finance, you really need to understand the property behind it. You need to be an expert in the real estate field. You need to understand your real estate markets and assets. And well, I think at Corestate, as we do both equity and real estate, we are in a pretty good position here. But again, I cannot stress this strong enough. You need to be an expert understanding real estate if you want to do successful real estate finance and giving out loans.
And the experts are here at Corestate. Thank you so much. Also, you only could give us a sneak view into the study. You made me keen reading it. And whoever is interested in this study can find it as well, can find it on the website of Corestate. Mark, Georg, thank you so much for this interesting talk.